Hello, this is Michael Prestwich. This is part 2 of the multi-generational IRA training. If you remember, Frederick had $500,000 in his IRA. He took income from that IRA over his wife's lifetime and then left it to children and grandchildren. The total income from the $500,000 was $1.2 million. This training will show you the nuts and bolts of how all of this works. This is page 4 of the Stretch IRA illustration. As you can see, it tells the story of Benjamin Franklin, who left $4,000 to accumulate for 200 years. The important part of this illustration is that Benjamin Franklin understood the interrelationship between time, money, and compound interest. The longer you can let money accumulate, the more return you'll get on your money. The purpose of this illustration is to show you how you can stretch your assets over 82 years and produce income across several generations. Based on the assumptions in this report, it is possible for the $500,000 in assets in your account to generate approximately $1.2 million in future income to you and your beneficiaries. To make this concept work, let's go to the page just before this chart, where, as you can see, we have the primary beneficiary, which is his wife. Anytime you have a wife in our software, she needs to be 100% beneficiary. And so, as you can see from the assumptions, Frederick is assumed to die at age 84. Then his wife will, since she's younger and also lives later, she will inherit as a 100% beneficiary. We showed the printout on her. And as you can see, she gets a payout from age 80 through age 87. So there's 8 years of payout for her. Then the kids and the grandkids then split. So if we go back to the inputs, here's the next generation beneficiaries. You've got John, the son. You have the date of birth. For this to work, each one of these beneficiaries needs to be named. You need to have on the beneficiary form, you need the person's name, their date of birth, social security number, usually the address, and other information that will unequivocally identify this beneficiary. So we've discussed the beneficiaries. Now let's discuss what can go wrong and what you can do to help your prospect prevent those things going wrong. The first thing that can go wrong, let's go back to the Benjamin Franklin. The first thing that can go wrong is that the people lose their money. Notice that Benjamin Franklin put his money aside at a very modest 3% safe rate of return. Didn't put it in real estate, didn't put it in stocks, didn't put it in gold. It was a 3% fixed return. That's why we used a fixed indexed annuity for this illustration. The second thing that can go wrong is that you don't have a proper account. Let's go up to this page. Will you leave your family a legacy or a tax bill? Your IRA's chief strength is the power of tax deferral. However, tax deferral can become a huge tax liability if your beneficiaries take a distribution after your death that causes the entire balance of your IRA to be taxed. Your beneficiaries may suffer adverse tax consequences if your IRA has an inflexible custodial agreement or if your beneficiaries do not follow the advice of an expert financial advisor who knows exactly what to do and what not to do with your IRA assets after you die. What does that say in a nutshell? Your customer needs you, and it needs an account that has the proper custodial agreement so the beneficiaries can take over afterward. For example, what could go wrong with a 401k plan? Look at the custodial agreement. I've never seen a custodial agreement in a 401k plan where they will continue with the wife after the husband's death. Ask your prospects this question. Fred, after you pass away, Everyone's at the funeral. Can you see your oldest son, John, coming up to Mom? Mom, didn't Dad have a 401k? Aren't you the beneficiary of that 401k? Maybe you should call and get that money. Can you see that happening, Wanda? Yep. You're not a financial expert. What you don't realize is you call up that company, they send you the balance of your 401k, and you get $400,000 check. And a year later, you get a $139,000 income tax bill. That's what happens if you don't have the correct custodial agreement. The reason we do business with an insurance company is insurance companies have been doing beneficiary planning for hundreds of years. Stretch the money out over the 70 or 80 years so that you can get the maximum compound interest from this account and pay the least amount of taxes. If you'd like to learn more about the multi-generational or Stretch IRA concept, visit us on our website or give us a call, 877-510-4702. Thank you very much.